Okay, I will call the meeting to order. I'll begin by acknowledging that in Treaty 1 territory and the traditional homeland of the Métis Nation. My name is Neil Harden. I'm chairing today's panel, and with me is Ray Massicott to my immediate left and Marcel Rolando to my far left. The assessor today is David Penner, and the recording secretary is Hada Aziz. We will be hearing applications for revision of the assessment rule in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and will limit discussion to those matters. The statements of the applicants of the assessor make at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the board. The board is appointed annually by council and is independent of it in the city administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of Queen's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included in the board's order. With respect to the hearing process, I will confirm the matters to be addressed with each applicant following swearing in. We will then have the assessor's testimony followed by questions the applicant may have, and then the applicant's testimony followed by questions. The assessor will have an opportunity to summarize if they wish. Once all the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You will receive the order by registered mail as soon as possible. This information on public hearings are live stream recorded and be part of the public record. So swear them in.
Please state your full name.
David Thomas George Penner.
And do you swear the evidence you're about to present is the truth and the whole truth, and nothing but the truth so help you God?
Yes, I do.
Thank you. Please state your full name.
Excuse me, Rocky Newfeld.
And do you affirm the evidence you're about to present is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
All right, the first item on today's agenda is 1763 Henderson Highway. So,
That was 15-1.
oh, so sorry. 477 Westwood Drive. Okay, you can proceed.
Thank you, Mr. Chairman. The file number is 19-4767. The roll number is 0755007100, 477 Westwood Drive. The owners are T&D Enterprises Limited and 2819857 Manitoba Limited. The value in the roll for 2020 is $4,471,000. The details of this hotel are listed there. Licensed capacity 725. There are 48 VLTs, 25 guest rooms. Before I start, I'd like to say I've reviewed the valuation and I'm prepared to make a recommendation to settle this at $4,171,000. Mr. Neufeld?
Yes, thank you for that. We do have one issue that we want to go over only, and that has to do with the management fee. So the rest of the work is, in my opinion, quite acceptable.
What did you say the value was?
$4,171,000.
Okay, since it's not being accepted, then proceed.
Okay, thank you, Mr. Chairman. On page 2 of my brief, we see this property sold in 2007. Some time ago, the value is listed there. The income approach summary is on pages 3 to 4 of my report. As you can see, we've shown 3 years of financial statements here and the stabilized column on the far right. Essentially, we've used 100% of all the revenues and expenses. The only difference being the management fee, which is standard at 4%, and the reserve for replacement at 3%. So total revenues is $3,706,233. That excludes VLTs, which are listed at the bottom. Departmental expenses are $1,847,480. the same as the 2017 actuals. The undistributed expenses are all actuals except, as I said, for management fee. The management fee was listed in the mailer at $192,972. We use 4% for all hotels for management, so we've used $177,702. Franchise fees as reported, and FF&E reserve a standard 3%. Business taxes and property taxes are as reported, as is insurance and other expense. So those total $228,048. The NOI before VLTs is a minus $181,123. VLT income, we use the actual 17, $736,319. So the total NOI is $556,196. So the difference between the actual 2017 reported and the stabilized falls solely within the management expense, which we reduced by $16,000 from reported, and we added $111,000 for reserve, which is not listed in the financial statements. So using a cap rate of 12% and an FF&E deduction of 10%, which is standard for beverage hotels, we derive a value of $4,171,000. As I stated, this differs from the original value, which was $4,471,000, but it is my recommendation of the value that it should be $4,171,000. On page 4, we have a breakdown of the A&G expenses listed there, and we have a reconciliation from what's on the mailer and disallowing expenses which are not allowable for assessment purposes. The rent that's listed there does not pertain to the hotel and is added back. So the income, net operating income for 2017 is $652,113. The cap rate of 12% is the standard cap rate for beverage hotels. Turning to page 8, we have some photographs of the subject property showing there some different views, some views of different rooms, a banquet center, a lounge, restaurant, beverage room has pool tables. VLTs are shown on page 15. There's an outdoor patio. There's a bowling alley in this premise in the basement. That's shown on page 17. So the features of this hotel are shown on page 18 there. I don't think I need to go through all the features of this hotel, but you can read through that if you wish. They're also summarized again on page 19. The features, the hotel amenities are all listed there. Guest room information is shown on page 20. And different features. Smitty's restaurant is in this location, Smitty's lounge, VIP room, and the outdoor patio. The financial submission of the owners is shown on page 21, 22, and 23. That is the source of the financials that we used, and as I've mentioned, we used 100% of the actuals with those two exceptions. So based on my presentation, I believe the value should be reduced from $4,471,000 to $4,171,000. That is my presentation. Thank you.
Any questions, Mr. Newcomb? Yes.
In regard to the 4% management fee, you could confirm, or can you confirm for this board that under what's called the Rushmore method is for the removal of goodwill and business value?
Correct.
Okay. And can I assume in this case that it was likely deemed that the stated income here of $123,000 to $192,000 was deemed to be profit-taking and therefore offset with this cost?
I wouldn't make that assumption. I would consider it a management fee, as that's what they've listed, and traditionally they've listed a management fee in and around 4%. So I'm taking it as a management fee.
Yes, but a management fee is for provision of services and labor on the site, correct?
Right, so this would have that effect. 4% would
But
have
the
that effect.
application of the deduction is over and above this, and it's to be applied to recognize goodwill and deletion of the business value, is it not?
I wouldn't see it that way. I would suggest that 4% is the cap, and I would not add 4% on top of what's already claimed as a management
Well,
fee.
I just want to make the point and move on. So I do have a few municipal board orders. I did have a copy of the Rushmore. I didn't print out copies of it. I can hand it out now or for rebuttal, but I just want to move along here.
You can hand it out now.
Okay.
But I think you're going to be questioning any.
Well, it's just that I had asked a bit of a leading question, I suppose, so there's...
All right, cross-examination, you can ask leading questions.
Yeah. Yeah, no, there's three separate orders here.
Okay.
So that one was, well, actually, it might be four orders here. Sigmar. One more. Yeah, there were four, I'm sorry. These were just, I picked a year at random. Actually, I picked the 2004, 3-4 year because that's when this matter had the greatest debate at the municipal board. And all of these cases deal with a dispute on the management fee side, and all of these cases end up with the same statement on the summation. And just the first one I'm opened up was the Canad Inn on page 24, management Canad Inn order. So in that particular case,
We gotta find it first.
okay.
Sorry. I've got it.
No, I think that this particular order was one of the ones that was being viewed carefully because for this one, the city had hired Russell Reynolds to represent them, and then the Canad Inn had hired their own expert, Mr. Rosen. So this is the one that was generally followed, and in this case, the city put forward the position that the 4% covered everything, and said that Canad Inn had their own management fee, and therefore that was covered in the 4%. So the decision was that the actual expense of management was allowed on page 24, and that was $550,000. And then to remove the management / business value, an additional 4% deduction. And that's pretty much the way these rulings have, the rest of these, we can repeat and go through every single one, but to save time, they all say the same thing. The city at one point said, no, 4% is covered in their management, and the board said, no, it's not. It's not for running the place. It's for taking out the business and goodwill, nothing else. So I think we're all aware of that, and the more scholarly short article, I'm sorry, I didn't print off a whole copy here. but copyright material licensed by me. Yeah, I bought this. Mr. Rushmore's shorter version of the article on this concept, and this was the style of valuation that had been reached after the bitter debates between hotel owners and the city when the valuation method changed from cost approach to income approach, was the Rushmore method. So that was part of my question to the assessor. I just wanted to clarify that this was indeed the case. And I just had one other question for him. Operation of hotels, they're not all the same, are they? Like different hotels have different profit centers and run different ways?
Yes.
So if a hotel has different ratios of beverage to rooms to food, you would expect their labor costs to vary according to the demand of that particular business function?
We would.
Okay, thank you.
Okay, Marcel, any questions of the assessor?
Oh, may I, Mr. Chairman? I'd like to just hand out this, I guess you could call it a rebuttal. This is just the manual evaluation of hotels.
Okay.
It's good information and it does speak to the management fee. Most of you have probably seen it already anyway, I would hope, but if not.
What a morning of reading, anyway.
So I'd just like to turn your attention to page 3 of the document. And this is called Income Attributable to Management. And it states there that a management fee expense equal to 4% of total revenue is deducted for all hotels. And it tells you the variations if there's a vendor or VLTs, how it's calculated. So it's a standard 4% that's applied to all hotels. And this hotel is no different. If they actually reported a 4% management fee, then we would use exactly that. But it's 4% for all hotels, and in terms of fairness and equity, we would not want to deviate from that in this case. And basically that's why we use 4% and we use it for all hotels. Thank you.
Just a question on that, top of page 4, last sentence. It does say that it's considered to account for the income attributable to the business, correct?
Right.
Okay.
All right, Marcel, do you have questions?
Not at this time. We're still reading.
Yeah. Ready?
I don't know who to ask this to. There was suggestion that the management fee is not really a management fee, it's sort of a write-off of a goodwill? Is that
That's correct. That's what the standard has. That's what the Rushmore method
But this is not what this says, what this document says.
Well, goodwill can be considered income attributable to the business as well. So 4% effectively removes the income that's attributable to the business. That's the purpose for it.
Yes, and that we're not in disagreement on. What we're saying here is that it's to take off the business income, but in this case, it's being leveraged against an actual expense. And that's not the intent. Now, there are cases where, maybe for tax purposes, many owners will put profit-taking through their accounts, and I'll get to that in my presentation. And when that happens, and the assessor says, look, you've got profit-taking in your statement, so we're going to use the 4% against that. That's a reasonable practice, and I'll get to that in my presentation.
If I may, Mr. Chairman, profit-taking would be done in the form of a dividend, which would be paid after the calculation of net income, not within the calculation of net income. They clearly list this expense management fee on their mailer, and we're not in a position to debate whether it's really a management fee or
I'm
not.
sorry, that's not what I said whatsoever.
At any rate, it has the effect of removing the business value from the valuation.
Okay, but that's not what I said.
Could you repeat that last part again?
The management expense is to remove the income value from the business, right? And so they're reporting a management fee on their mailer, and we're capping it at 4%. And that has the effect of removing the business value. Now, if this was an amount of profit-taking or equity, as it were, that's taken out after the calculation of net income and paid in the form of a dividend, which isn't a deductible expense in the calculation of the income. It comes out of equity after the calculation. So they've reported a management fee. It's slightly in excess of 4%, and we capped it at 4%, which is the same as for every other hotel.
Okay, if I can follow. Then the management fee is not an actual expense, it's just a percentage of.
Yeah, I mean, a lot of businesses don't report a management fee at all, and so it will show as 0,
Yeah.
and we'll add 4%.
Yeah.
So it's 4% regardless of if they report 2% or higher, it's always 4%.
Anything of the assessor, Marcel?
Not at this time. We'll show the presentation.
Yeah. I got some questions of Mr. Neufeld, but we'll wait for his presentation, so you can give us your presentation now then.
Thank you. Ours, as I said, is a bit truncated. We had an opportunity to discuss the matter with the assessor, and we do, as I mentioned, agree with everything else that's done. So the sole exception is the 4% management calculation. And our workup on page 3 was prepared prior to that time. So on page 4 is an excerpt from, this is the main page of the mailer that was sent out, and this is also included on the assessor's workup on page, I gotta go to that one because that's when I marked up, page 22. So it's the same, this is the summary page. And on the summary page, the actual NOI here is $191,997. Now what the assessor did is line item 730 was removed. Now, upon our investigation into that was profit taking. So that, yesterday when we were discussing this with the assessor, I was just waiting for my response from the ownership, just to clarify what that line item was, profit taking. Now, the item that they've, the rest of the statement doesn't entirely match the assessor's workup because they reallocated the costs into different categories and split out the management fee, as they called it. Now, the management fee that they're claiming is an actual expense, and that's listed on the assessor's page 24. The property is part of a multi-role hotel business. They own 2 other hotels. I think they acquired a fourth, and the others are in rural Manitoba. And the much like the Canad Inns example, which I showed you in the beginning, they have their own operating company, and that's where the $192,000 goes, running of those operations. It's a pure expense, just like the Canad Inn decision that I'd shown you. And so that's why I put a lot of weight on what they did with Canad Inn. So the 4% is, and it's true, oftentimes in some hotels, they will put in a management expense because in Canada we have the right to run our businesses in a manner that pay the least amount of income taxes as possible. That's our legal right. We can arrange our affairs to pay fewer taxes as long as it's legal. We can't avoid taxes. So in running a business, as we all know, you have different options. You can dividend yourself, which in this day and age is actually costs more than just giving yourself a straight T4, because the rules have changed dramatically on dividends, and it's no longer the best way to go. And there's other ways of reimbursing yourself. And many operators then take their profit taking out through there. And then we have examples of them, and we've been through it on some of the other properties that were resolved, and we freely admit that we noticed that there is profit taking in that management fee. It was like $600,000. So of course there was profit taking. This is a pure expense. So we're missing that deduction, which is the removal of the goodwill. And just further backup to it, and I am under oath and I do not have a copy of this, and I ran this, and this is dated material because it wasn't for this specific year under question, but I asked them, the owner, to prove it to me. This is from 2 years ago, and in this particular year, which was 2 years prior, the numbers were very, very similar in that we had a total payroll of $1.4 million, which included $443,000 in profit taking declared on a separate line item. In this case, line item 730 in the assessor's workup. The rest was all T4'd out. And management wages this particular year were $144,000. So this is consistent with their operation, and it's a pure business expense. And of course, the other issue being is that last year we had an agreement of value on this. You can see at $2.9 million. So hotels didn't increase in value over this time period. I think it's just a simple semantic issue of attributing the management fee, which is supposed to be purely for removal of goodwill, as taking out an expense. So in essence, the assessor is wiping out a legitimate expense. And had it been for profit taking, we wouldn't be having this debate. So I haven't recalculated the assessor's position. Ours is slightly worked out slightly differently, and again, probably I'd like to rework it, but unlike your normal revenue-producing properties, this would take about half an hour to rework the numbers. So we will, for now, ask you to consider the value we did put forward as our alternative. Otherwise, I would request that we look at the assessor's workup on page page 3, and reinstate the expense of the management fee, which should be averaged out for the 3 years at $161,407. Now, if you add that expense in, you have to remove the portion for the 4% and 3%, so times 0.93. So that's a difference on the NOI of $150,109, and capped at 12%. Is a deduction of $1,250,907 less the 10%. Is a removal of $1,125,816 from the value, which would then be $3,045,653. So that's just on a pure adjustment basis. Doing it that way is it would be $3,045,653,000, which is an increase over last year, a small increase over last year. The last point to make on the concept of is this an expense or not is to consider the nature of this operation. Your typical beverage room, the labor costs will run lower than food service operations because your labor consists of taking a drink and serving at the table, but you don't make the drink in the back, and you don't make the beer in the back. Whereas if you're selling food, you have to pay for the cook and you pay for the server. So costs are higher, and of course, the costs on the VLT are very, very marginal. You can see from the statements that the predominant source of income is the restaurant operation, which indicates a higher wage base to start with. And being a chain restaurant, you would also expect to have standards in place that it's going to be table service. My particular experience in the chain restaurants was some time ago, but was quite extensive. And we would expect labor costs between 32 and 35% in a Smitty's operation alone, compared to beverage rooms, which are typically in the 20% category. That's why these costs are reasonable. So my modified number, again, is reinstating the stabilized management cost, which is a real cost for running a 3-unit hotel operation, and comes to $3,045,653, rounded to $3,046,000. Thank you.
Any questions, Mr. Kyle?
Yes, thank you, Mr. Chairman. On page 3 of your brief, I note that you use 4% management fee, $177,702.
Yes.
And your position has changed on that?
No, I think that this workup we have here was done before we had an opportunity to review with where we want to go. And you'll also note that that the numbers don't flow the same as format that you've used. And we do 4 hotels a year, so it's not, we know what we're doing, but formatting for this particular automated calculation of value, everything's done by hand. So that's this one was prepared again on there's another difference here. There's another. Yeah, there's actually a line item here that doesn't belong, but it's an error, that's all I can say.
So, if I work through your numbers, it looks like you're using actual expenses, but you're using average revenues against those actual expenses?
I'm not entirely sure, I don't have that work up here.
On page 3 on the right,
Yeah.
you see those numbers match our numbers, which are the actuals.
Okay, yeah.
But the
okay.
revenue, you're using 4,343, 287, as opposed to the actual in your calculation. So you're mixing actual expenses with
yeah,
average
yeah,
revenue.
Right, yes. No, I didn't do this workup, but yes, we've been looking. There are a number of our properties. There are within valuation. There are certain times you can consider when you're stabilizing whether to use the last year or to use an average of some sort. And in the, for example, the apartment world, we use an average of expenses with the last year of income because the income is always rising. 99%.
I understand that, but if you're
But hotels differ.
you can't. What?
Hotels differ.
You think it's proper to use an average for revenues and then not an average for expenses?
Well, the downside on that is that expenses are always on the rise, and utilities especially. So I didn't prepare these numbers, and you could have a valid point there, and I can't give you the difference in what that number might be, whether it be higher, whether it be lower. But what I said at the beginning of this hearing is that we're no longer relying on this. We have one issue only, which was after seeing the workup you provided, we reviewed it and we're content with it except for the one line item.
So the irony is if we used the 2017 actual revenue and floated through, your NOI would be 569,000, which is essentially the same as ours, at 556. Very, very close.
No, that's your stabilized is 556. Your 17 is 652.
Right, but I'm looking at your stabilized. If you use the actual revenue against the actual expenses.
Well, I respect your right to ask questions. Just bear in mind that I'm not going to rely on this. This is just a workup we had to put in place as we were working on it. This property 2 years ago, there was a gross error made in the calculation, and it was there's a strip mall next door, and if you look at your main statement, the strip mall is this is on your statement that you provided on page 25, and the line item 4,400 rental income. So in past years, what's happened is that rental income for Westwood Plaza ended up going into the subject property and mistakenly so, which is why last year there was a very large reduction in the value because it was placed in by error. So when we first looked at this and we were talking with Jason about it, we never got his workup. I think we just got the workup with the brief. And all due respect, people are great to deal with in the hotel. They're very, they want to resolve issues. And we made an assumption that that mistake was made again because, the value jumped from 2.9 million to 4.4 million. So to us, we just assumed the same error had been made. So what we did is we prepared a valuation, a cursory valuation. Then after we saw your workup, we understood what our area of contention was, and given our time constraints, we did, I know Eric told you yesterday we were looking for one more answer, and today, last night I finally got the answer, and then today we're content. I told you we're agreeing with your workup. So this means nothing. It's just one issue in the goodwill.
That's all my questions, Mr. Chairman.
Okay, are some questions?
So which line on page 3 did you put that 161 in?
We didn't. This was just meant in place to do it. It would just have been with the general expenses. Like it's got the entry. Oh, I'm sorry. I didn't put it into my workup. I put it into the assessor's.
That's what I said.
Oh, okay. I'm sorry. On page.
It's just that's the way you presented it on his
Correct,
page. That's
correct.
why I asked you the question.
What I did is the 4% stays for goodwill, and then we have an additional management fee which can be added back into wages at some point, and which is an additional 161,407, which is the 3-year average.
And you add that into wages.
Add that into wages, yes, that was the amount. And then I took, because it's an additional expense, you have to take off the 4 and the 3% off it because otherwise you get a double expense. And that brought it down to 150,000. And I capped it out, and then I subtracted another 10% because, again, you don't want a double expense. And that's how the total adjustment was 1125,816.
Okay. Thank you.
Ray, anything?
You had presented something that you now abandoned because you like the city's presentation better.
We thought there was a mistake, and it was, I guess we were waiting to the last minute to see if we could sort it out, and we didn't have it, so we put in, call it a placeholder. It wasn't so much as abandoned, it was just,
Could you?
it's not.
I wanted to intervene here when I've heard, I mean, not just you, but other agents too, have said we put in the brief just as a placeholder.
Yeah.
It's not intended to be a placeholder. It's intended to be the value you're going to be defending at this hearing. And the city has every reason to expect that the brief you place you exchange is going to be the one that you defend.
You are correct, and we are at fault.
Okay.
Our only mitigation of that is that we were under the assumption it was the same mistake as last year, which was leaving in the Westwood Plaza income.
Okay. Any other questions?
No, that's really it. It seems like you're just picking, you're choosing it.
Right.
You know,
And that is not something I do as a practice. I think it's the hotel world provides you with a more complex, more detailed, more numbers. And when we originally do evaluation for other types of properties, I think that the income method, you can present an argument, and you can listen to the other side, and you can make adjustments and changes. And because part of this is trying to reach consensus, but no, in this case, it's a half an hour recalculation. That's all. It's just more complex. And I don't want to say this to sound bad, but we also respect the workload that the board would have in order to do that calculation. If we went and started right from the beginning and said, the results of this, here's our number, you'll have an awfully difficult time making a decision, because it's, again, a half hour of your time to rework all the numbers. I'm presenting a very simple issue, and we were straightforward with the assessor. Yesterday we said we wanted to review one item, and your point is well taken. Cherry picking isn't the nature of the game here, and that's not something we practice. Except today.
Okay. Is that all your question, Brian?
I may have another one, but you go ahead.
Yeah, I'm not getting your point on page 23 of the board order that you referred to.
Okay.
If you look at the last paragraph, the A&J is similar. And the difference was that the city had allocated $285,000 for business value, and the appellant wanted $614,000. And then the board goes on to basically accept the city's values on both A&G and business, the 4% of total revenues.
Which one is that one, Mr. Chair?
That's the Canadian ones on page 23 and 24. Bottom of page 23 and 24. Last full paragraph.
Well, the discussion on it is on page 18, 19. And in the discussion, and then the workup on the discussion on page 18 and 19 is the owner was bringing forward the point that the management fee was for the parent company, and the assessor took that management fee for business value and applied it without regard for the management fee of the parent company.
The essential ruling was that the city the board accepted the city's values.
Well, the ruling was the management costs undistributed were then awarded at $550,000, and then the business value $282,000. And one of the other issues under dispute in this case was on what is the 4% to be applied. Earlier on, the owner had requested it to be applied to a greater range of items, and what the board said is not that greater range. It was a more limited range on it. that the second paragraph on page 24, the owner had requested the management and reserves to be put on the VLP and vendor costs, and the board said they've been adequately accounted for in the other allocations. So essentially, on page 26 of the order, you can see where those costs were inserted in difference to the first workup presented by the board, by the assessor, I'm sorry. That under the undistributed expenses category, on page 8, which is the assessor's position, was 2.4 million, so the board changed it to 2,635,000. And the line items that changed, a little bit more in light, heat, power, a little bit more in repair and maintenance. I was going to refer to the other orders in summation, but they're also the same issue. I read it this morning, it was so easy to find. Yeah, okay, sorry, I found what I was looking for. This is on the order for T&D Enterprises. And page 8, the last two paragraphs and the first two paragraphs of page 9. I'm a bad reader, so I'll just let you look at it. Basically, it says that whether or not there's business value to deduct or not. It's a standard deduction, but there's some business value, and 4% is what's going to be applied. Not management expense.
Okay, and I have no more questions. Any questions? I saw you said you
I'm still reading. Okay, on your page 9 that you gave in that report, the board will accept the appraiser's evidence regarding the removal of business value, and the board will allow 4% of gross revenue less vendor expenses.
Right, and that was the other issue where they were asking for the 4% to be applied to the vendor income, and in some cases the vendor and the VLT, and what the board is saying is it's not based on the gross vendor income, because the vendor could have $2 million in sales, but $100,000 in net revenue because of the markups. 6% or something like that, right? And so you don't take it off the gross number, is what they're saying.
But does this support your argument that it should be in addition to the management fee?
Yes, yeah.
You read that in here?
Yeah, well, in this case, they had the actual expenses, and so they weren't disputing the actual expenses. It was just a question of whether or not the business value was done adequately, and the debate in this case was that it was put forward that perhaps there is marginal to no business value, and the board said, well, we're still deducting for business value. And it's been the case since 2000, early 2000s, where the 4% is applied unilaterally and is not put off against an expense. And the only time that is allowable if we can show that it's profit-taking. In this case, as I mentioned, we have a profit-taking line already, so it's not a double expenditure. It's for the operation of their business.
I think the argument, I don't think anyone's arguing about the 4%. Your argument is that the management fee that's been charged is in addition to the 4%. That's your argument.
Well, yeah, yes. Yeah. Well, the management fee is an expense. The actual management fee is an expense. This management fee is a deduction to take the goodwill out of the property, because you can't tax goodwill.
The 4%.
Yeah, and that's been the decision right from the beginning. Is that the hotel owner said, look, you're after my income, but my income comes from my business. So the Rushmore method said, right, we agree with you. We are taxing your business, so therefore we're going to allow these deductions, and it's 4% to account for that.
But these municipal board decisions, they did not charge an additional management fee, right? They allowed. That wasn't one of their costs.
They allowed the stated management fee, the stated operational costs.
There was some management fee.
Yes, well, whatever the operational costs were, like. It's the same concept as any revenue-producing property. If you have actual income, you should first look at that, and if it's higher or lower than the model, that's not the point. Every property is different, so they allow the actual income and then an additional 4% removed for business.
But the actual expenses of these organizations did not necessarily have a management fee. Like not every.
Correct.
Yeah.
Correct. And whether you have one or not, that's what the orders say. The 4% is for business goodwill, which is over and above that amount. the hostility between the hotel owners and the assessment department peaked about this time, and lots of court action on it. But eventually, this was the model that was adopted by all sides. And I did speak to Mr. I can't discuss what he said, but I did speak to Mr. Newman this morning and consulted with him on just to make sure my theory was down pat on this. Because he, of course, was at this hearing and does a lot of hotels, but it's exactly the point. Now, probably the real problem with this all is it should never have been called a management fee, the 4%. It should have had a different name, and we wouldn't have this debate. It just should be called a business.
Where have we heard that before?
Yeah. Is it?
Okay, any submission that you wish to do?
Yes, thank you, Mr. Chairman. So, a starting point in preparing for a hearing would be looking at the appellant's brief, as you alluded to. And for the most part, I didn't have too much issue with it, aside from using average revenue and applying it to 2017 actual expenses, which creates a bit of a mismatch. However, 4% management fee was used in that workup, which is what we use, and 3% reserve for replacement also used. The only other point of contention would be 15% was used for FF&E, where in beverage hotels that's a standard 10%. So those are the only issues I had with that. Just getting back to our approach, if you look, we're using 100% of the actuals and only altering two lines. The management fee, we're capping at 4%, as we've heard, is the standard, and you see in all the board orders before you, and 3% for FF&E reserve. So Mr. Neufeld wants to take an item that's reported as a management fee and has been reported that way for many, many years and say, but it's not a management fee, let's put it somewhere else. Let's call it management wages. If we do that, we're essentially allowing 7 or 8% for management expense here. It is 4%, that's standard, that's how we do all the hotels. We believe my revised numbers are accurate reflection of the actual financial statements, and the value is solid at $4,171,000. It's consistent and fair and equitable with all the other hotels, and I ask that the board consider that value. Thank you.
Okay, Mr. Neufeld?
First of all, my apologies to all with the manner in which the evidence was presented to you. I ask you to just have a bit of patience in this respect, because oftentimes we come to the hearings and the lines have been drawn. In this case, generally with working with the hotels, there's a good spirit of cooperation, and this was a work in progress. I hope that the people in the hotel valuation, we did discuss our issues, and you know what, the system worked, because we came here today not with 10 problems, 10 issues we didn't like, we just had the one. And that's a good thing, not a bad thing. Now, it's clear that the 4% is for a deduction for goodwill and business, despite its name. If the actual management expenses concern running the operation, they're a legitimate expense, and they're part of the operation. As I said, it's fairly complex and more labor intensive than your typical hotel. It's a little bit more than drawing a beer or dropping it at the table and washing the glass later when you're running a food service operation. And all of the income you're looking at is business income. Well, I'm sorry, there's $178,000 in rental income from their tenants listed in here. So the rest of that income is all business income. So the Rushmore method accepts that business income can be converted to real estate value. And In that conversion, there's a required adjustment to remove it. And I only have the one copy, and obviously I can't enter it as evidence, but the murkiness of this formula makes it more difficult to practice, and it's more confusing. But it is fairly simple. Look at what you're actually making, the actual expenses, take off 4%, take off 3%, take off the FF&E after the value, and it becomes a simpler formula. And so we were not cherry picking. We knew that this was but you can't take a business deduction, to take the business out of it and balance it off with an expense for running the operation. That's not the intent. The intent of the 4% is to recognize that business. Now, lastly, while working diligently with this, I would remind the board that the value from last year at $2,900,000 was a recommendation, which we accepted. And I find it very difficult to believe that the value went up 40% over that period. Because listen to the other hotels today and look at the numbers from previous years. They're all going down, not up. So it's not fair and equitable. Thank you very much.
Okay, let's take a 5-minute break till 25 after. Okay, we're going to 393 Marion Street. All right, you can proceed.
Thank you, Mr. Chairman. The file number is 19-2254. The roll number is 0609-327-4700, 393 Marion Street. The value in the roll for 2020 is $2,175,000. The details of the property are listed there, including a licensed capacity of 595 seats, 36 VLTs, and 25 guest rooms. Have a recommendation on this one to reduce the value to $1,975,000. Mr. Neufeld?
How do you feel about that, Julian?
Yes, I'm in agreement with it. We're just waiting for the owner to sign off on it, and so we'll take it as a recommendation.
Okay.
Although I would like to point out page 6 should be of interest to all of you in terms of management fees.
Okay. $1,400 Notre Dame. It's the Canadian.
Canadiana Trip Lodge.
You may proceed.
Thank you, Mr. Chairman. File number is 19-4704. The roll number is 13003-130100, 1400 Notre Dame Avenue. The owner is 100422123 Manitoba Limited. This is a new owner, and just a housekeeping matter. Just would like to ensure that there's authorization from the new owners to proceed with this.
Mr. Neufeld, is that?
That's a question asked the board, not me.
Well, there's got to be a letter authorizing to.
Who's the new owner?
Who's the new owner there, Mr. Chairman?
It's 100422123 Manitoba Limited.
I have it from Edwards Holding Limited.
That's the original application. You've got a letter in there.
That's one.
Well, we sent it in on October 18th.
I don't have anything, so I'll make a photocopy this and put
Okay,
it in the file
thanks.
then.
Yeah.
Well, I sent it to Jason,
Okay.
because that's the only way he'd release the data to me,
Okay.
so.
Okay.
Sent to the assessment department.
Did you give the recommendation that you?
No, I haven't gotten there yet.
Okay.
I just wanted to clarify the authorization.
All right.
Okay, so the value in the roll for 2020 is $8,880,000. This is a beverage hotel, the Canadiana Thrift Lodge, built between 1968 and added on in 2007. The license capacity is 494. There are 19 VLTs and 67 guest rooms. I do have a recommendation on this property to reduce the 2020 realty assessment to $7,989,000. This reduction is based on using all of the actual income and expenses of the hotel and adjusting the value of the industrial strip mall, which is at the rear of the hotel, from $2,591,000 to $1,385,000. Mr. Neufeld?
How do you feel about that evaluation?
Mr. Spinner, you should present through the chair.
I apologize, Mr. Chairman.
That's right. There's a reason for that, but we won't get into it.
I need to know.
I've had discussions with the ownership on this, and I know their position, so we'll have to proceed on. Thank you very much for addressing one part of our problem.
Okay.
I'll
You can
proceed.
proceed on the evaluation then.
Thank you, Mr. Chairman. So turning to page 2 of my brief, I just note that the income approach summary will appear on pages 13 to 15 of my report. I'll get to that momentarily. There's an indoor water park featured at this hotel, a restaurant and bar featuring a DJ, karaoke, and billiards on site. The rooms feature cable TV. The University of Winnipeg is less than 15 minutes drive. It's a simply furnished hotel. There's a work desk and hairdryer in the rooms. Free Wi-Fi is available. There's a game room and lounge also at the Canadiana. Casino on site, i.e. VLTs. A sauna and a hot tub is available for guest enjoyment. Public transit is directly in front of the property. The Cave is the restaurant on site, a casual dining experience available for breakfast, lunch, and dinner. Winnipeg International Airport and McPhillips Casino are within 10 minutes drive. The Forks Market Square is 15 minutes away. Turning to page 6 on the brief, there's an aerial view of the map and an aerial view of the property. The hotel is at the front of the property on Notre Dame. The industrial strip mall is at the back of the property. There's a couple of alternate views of the property on page 7. Street level view at the top of page 8, and you can see the water park featured there on page 8 at the bottom. There's some small banquet space. There's the lobby shown on page 9. The facilities of the Canadiana, we've gone over some of those already. They're listed there on page 10 and 11. And page 12, which brings us to our income valuation. So their fiscal year ends March 31st, which lines up exactly with the reference date. So we have shown 3 years of financial data there. And our stabilized column is on the right side. And as I mentioned at the outset, we are using 100% of the actual revenues and expenses and flowing those down. So we have revenue of $3,899,308. That excludes VLT income, which is shown at the bottom. Departmental expenses are shown there. The beverage cost, we broke it up between the beverage cost and the vendor, and the entertainment is as it is. Undistributed expenses, we used all the actuals there, and again, we use 4% for management and 3% for reserve. Fixed expenses, we use the actual taxes for 2017. So we have a net operating income before VLTs of $626,284. To that we add the VLT income. So we have a stabilized net operating income of $880,594. To that we applied a cap rate of 12%, which is our standard beverage hotel cap rate. We applied a 10% FF&E deduction. Again, that's the standard deduction for a beverage hotel. And to that we add the value of the strip mall, which is at the back, to the total. The total being $7,989,000. As you can see, 2017 and 2018 were both excellent years and significant improvement over 2016. They made over $1 million in both of 17 and 18, and that is the main reason for the increased property value here. Turning to page 14, we have a reconciliation of the income from the statement to what we're using. So we add back amortization, which is not an allowable expense for valuation, and mortgage interest to come up with the net operating incomes shown on the prior page. Admin and general expenses are broken down at the bottom of page 14. Turning to page 15, we have the valuation of the strip mall that's at the back of the property. There are 28,800 square feet of space, and we've used a net rent of $425 to come up with the revenue of $122,400. We've applied a 4% vacancy and a shortfall amount and 2% for expenses. The net operating income is $110,834, and to that we used an 8% cap rate to derive the value of $1,385,000. The net operating income that we're using of 110 is in line with the actual reported income from the strip mall, which you can find on page 21. So we have a net rental revenue or net income of $103,000. To that we would add back amortization. So the net operating income as per the statement is $114,000. We're using $110,000, so we're right in line with the actual income derived from the strip mall. 8% is appropriate for a strip mall such as this in this location, and that's how we derive the estimated market value of $1,385,000. And this was the primary change in the value from the original value. The original strip mall value was $2,591,000, and I've seen fit to reduce the value of the strip mall. Turning to page 16, we see this is the income of the hotel only, and we can see the operating income listed there, $954,000, and again we add back amortization to come up with the actual net income for evaluation purposes. So again, we've made some adjustment and we're prepared to make a recommendation for a reduced value. As I say, that reduction is in the strip mall in its entirety. But this hotel has been performing extremely well, 2 years in a row with over $1 million in income. At 12%, we get the value of $7,989,000 for 2020. And that's the value that we would ask the board put it to. Thank you.
Okay. Questions, Mr. Newton?
Yes. Now, the workup on page 13, there was the change, the adjustment, but there were other changes as well. Actually, you increased the value of the hotel portion, correct? I mean, we were in discussions with this property for a few months, and I'd had a number on the hotel portion at 69.87, and now it's 73.38.
I think we had used the wrong number for taxes. We had added the taxes of the strip mall in where
there were some other costs though as well, such as the in your first workup, the room expense is now zero.
right.
And original draft I have 296,852 for room costs. So did that move somewhere?
No, we just presented the stabilized column exactly the way it's presented in the financial statements to avoid any confusion. We know those room costs are probably in A&G wages and benefits, but rather than move line items back and forth, we just maintain the presentation of the financial
Okay,
statements.
yeah, no, I see your point, because the total on the first draft has increased expenses in the undistributed, so you moved them back to the undistributed then, to coincide with the statement?
Right, we wanted to match, show that we are using exactly the expenses.
Okay, and that's okay, because we had based our workup on our first discussion, so I just want to clarify that. And you did note that 2017 and 18 had significantly higher income on the room side as well, correct?
Not just the rooms, but the food and beverage also increased, and the vendor looks fairly stable.
Right, and I would say that the increase was 48%. About right?
In which line?
Not from 2016 to 2017 for room income?
Oh, yes. About 300,000, yep.
40. Now, is that typical?
It can vary, but we saw it fairly stable between 17 and 18, so.
Well, did you consult PFK or
No, we're relying entirely on the actual.
Okay, and the province of Manitoba has also a RevPAR study. Did you look at that to see, was that consistent?
Well, some hotels are performing better and some performing worse. We're reflecting the actuals here.
Okay, so your opinion is that is a sustainable increase?
Yes.
Going to the management expense, I know that this was just added in, the 4%,
Yes.
not offset against any other number. It was just an additional deduction, correct?
Right.
Now, they have management wages, do they not?
Yeah, but they didn't report a management fee.
Well, they did, but it's included in the other ones, is it not?
Well, I don't know that there's a management fee here at all.
Not a line item for you to have.
No,
but
they don't.
Are they running without?
They report management wages.
Are they running without managers?
No, I would suggest that they have managers.
So it's likely included in the line item on wages and benefits then?
Well, their management wages would be in that line.
On page 17, for
Right.
example, there's a line item there.
Okay.
Okay. Property tax. Now, I'm looking here for in general. Sorry, my notes were made in the earlier version, and I was looking for something here. Just, I need 30 seconds. So I'm just trying to look back at that, the room cost, and again, for the line item entry, and I know the board doesn't have this, but in our discussion with your department, we had originally, they had a breakout number. So I'm just sorry, I'm just reading the schedules here. 17, okay, sales, cost of sales, purchases. Okay. Here, food. Okay, I answered my own question, apologize. The industrial part of this property is on the same title as this building, correct?
Yes.
And you run a separate income stream with it?
Yes.
Would a purchaser do the same thing?
I would think so.
Well, I spoke to the purchaser and he didn't. It is on the same title. Would you not consider having one rate of capitalization?
Well, perhaps a blended rate might apply, but we valued the strip mall the way we would value any other industrial strip mall, and added the value.
Okay. But you would agree that's not necessarily the way the market would look at it, is it?
I don't know.
And the work up here, of course, I was just looking for, oh, never mind, I see it, okay. Those are my questions, thank you.
Okay, Marcel, any questions?
No.
Ray?
No questions.
I'm just looking at your vendor cost. You got $1,008,000 there.
Right.
Is that just an arbitrary?
No, it's not arbitrary. Vendor costs are typically close to 85% of the...
Well, that's what it's not an actual, so that I can find them.
Yeah, no. They lump their costs together as one item. But we know that it's typically 85%, so I just split the $1,474,000 into the two items there. It's not broken down for us, but knowing that vendor costs are typically that.
Okay, because I was looking for it on your page 16, if there was a vendor
Right, no,
cost
it's not,
there.
it's not broken down.
Yeah, separated. All right, and then the beverage costs, $466. So that's again separating out the
Yeah, it's just the remainder of the cost. So the 67%, I don't know if that's what it typically would be, but I just wanted to allocate the cost to make sure we had the vendor cost correct.
Oh, I see, okay. All right, okay, I understand that. All right, you can proceed, Mr. Newfound.
Thank you. This time it wasn't my fault. We've been discussing this with the assessors for some time as well, and we had exchanged briefs and information with a colleague of Mr. Penner's and trying to work towards a solution. So some of the numbers you see here were based on first draft, and the idea behind it is like before, we were looking for areas where we had agreement on and then areas where we disagreed. And see, I got my red marks where we disagreed. But the workup is different. So, but there are two areas of disagreement that we're focused on here. And first is the income side of it. Now, we've used an average rather than the last year. And earlier I was babbling on about, do you use the last year, do you use the average? Depends on the property, depends on the experiences. Because we're representing a new purchaser, we also were able to interview him on his knowledge when he purchased it. In 2017 and 18, and it spread over both years, the property had a very huge number of tenants because it's one of the properties used to house First Nations when their sites were being flooded. And this is viewed as one-time income, not long-term. The longer statements going back years prior to that indicate a very stable room rental return of approximately $900,000 over time, and then the one-time bump. Now, at the time my client purchased the building, he was aware of it, and he based his purchase decision not on the last 2 years, but on a reasonable number. And so that's why we averaged it. Now, yes, there should be some consideration for it, but it should not be wholly relied on because it's weak revenue. We're at the fate of both government policy and the weather. And if bad luck for some people is good luck for hotel operators, that's just the way it is. So all of the income in the property, of course, is dependent on the rooms and the occupants in this sort of operation. But if you note the sales, now the assessor made the point, well, look, it's gone up, 48%. Yes, the rooms went up. Scroll down to the vendor sales. The vendor sales did not. That's the line to look at. Now, I've done a lot of work on hotels. One I was working on in particular had to do with expropriation, and we're trying to study the impact of the expropriation. And what you do is you look at the profit centers and try to figure out how each profit center is affected by externalities. And the constant, generally, in a beverage room is the vendor operation, because it's your same clientele who live nearby who go and buy beer, and you'll notice that the number was fairly constant, whereas the food revenues increased, which is related to the guests, and the beverage numbers were fairly constant as well, and that's the local drinking crowd. Those were constant. You notice the 641 from 2016 only rising to 695 by 2018. That's just about inflation. So the two line items of beverage and vendor indicate the revenue issues. Now, again, look at the BLT revenue. The rise is is 10% over the 2-year period, or 5% per year, yet the rooms went up 48%. So anyone who's looking at this statement would be paying attention to that. Those numbers are not sustainable. So we average them. So there's our difference with the assessor, is that rather than look at last year's, we ended up averaging them out, and that was our method of stabilization. Now, the numbers, because we did write these up slightly differently, the assessor's number over that time is $38.99 plus VLT of $254. So he's at $41.53, and we're at $40.32. So it's a difference of $120,000, which is a reasonable amount considering all of this. We're not saying disregard that income, but no one's going to invest money in property hoping that there's another flood. So that's one area of difference. The other area of difference is the concept of it's one property, how can you have separate cap rates? The risk level isn't a question of blending it and averaging it out. It's in real estate, it's worst case scenario. The biggest chunk of my income, $4 million in income from a hotel, $100,000 in income from a strip mall. You're not going to cap the strip mall at 8% and say it's wonderful. You're just going to use the same cap rate on the rest of the motel. Now, that's my belief. But in this case, I also asked the owner, the purchaser, what did you do? He said yes. That's what he did. And incidentally, his purchase cap was, I'm going to be careful in the post-reference stuff. There is a sale, but there's consistency on the cap rate on what he purchased it for. So our difference is there. So you see, sorry, we had another small difference here. I forgot, I put my warehouse rent in above. I wanted to give you the right numbers to compare. So my actual income, when I compare line item to line item, and forgive me that I don't follow their format, but we don't do this in the real world. Colliers has one of the best modeling for hotels in the country, and we publish twice a year. We've got studies, cap rate studies, all sorts of things. We don't do it the Rushmore method. We just put all the money in a big barrel and look at the sale. It's a lot simpler. Our income is $3,651,973. I just subtracted the VLT and the warehouse rent as compared to the assessor's number of $3,899,000. And that's our major difference. It's all about, we average the income, so that's a difference of $247,335 on income. Averaging the income rather than using the last year. So the layout is a bit different. I think we're going to just, the layout here is slightly different, and I understand that the management fee, or we'll call it the goodwill, we applied it on the whole revenue, and yes, it could it doesn't necessarily go on that, it just goes on a portion of it. We would concede those issues, but by and large, we were trying to have as few problems as possible. You'll note that if you scroll down now on the expense side, we are stating the same numbers on these line items. We ended up at 1846 rather than 1538, but you see the number up top there, the 296,852. That the assessor had moved down to the bottom category because we had a shortfall in that bottom category. They're at 1534 and we're at 1319, so we did just move them around. So the middle categories of cost of sales and expenses, our total was 31 3.1, and the assessor's total was a little under 3.1. And certainly glad to adjust any of those as required, but it's very marginal. The big problem is the income side. Then the last issue, of course, is the cap rate. So we're capping all of the income at 12%. And the only alteration I'm going to make on this is we used an FF&E of 15%, and that should be 10%. So that was an error in our part. So the extension works out to 5287,789, 5287,789, rounded to 5288. And yes, I did apply it to everything, including the strip mall, because it's part of the title. You can't split it up, take it out as you please. Now, if you care to make the adjustment, that's fine. I just don't believe in splitting interests. Again, the site was sold in August of this year, and we did fill out the mailer on the sale and did have a conversation with the assessment department and sent in all the forms. Along with, we made sure they had the statements, and I did the forms myself and got them in right here. We're so compliant. And again, we're not out to debate.
Well, I don't want to hear anything about a post-reference sale.
Absolutely. I think in all fairness, we can talk about trends, because the assessor opened the door. He said there was a 48% increase in the revenue on the room side. I can say, as a rebuttal to trends, is the sale price did not reflect the
Now
trend.
again, we're talking about post-reference sale. He talked about a trend up to the reference year.
Oh, no, yes and no, because the sale was entirely based on the statements that you have in front of you.
Regardless, I mean, we're not talking about a post-reference sale.
Okay, but you understand my point, is he was looking at the same statements.
That's fine. And it will be reflected next valuation.
All right, thank you.
Okay, any questions, Mr. Tanner?
Yes, Mr. Chairman. Mr. Neufeld, on page 3, your workup, under 16, 17, and 18, the numbers there, 3.2, 3.7, 3.8, I can't get those to add up. With the lines above.
I see it. Well, let's look at the main one. Okay, so the stabilized line lines up. So I believe what these numbers represent are, and I'll just double check this. Yes, those lines represent, don't take into consideration other or VLT. And so they weren't relied on in the valuation, so I think it was a method that we were trying to look at the application of the FF&E reserve on those items with the subtotal. But in the long run, what we ended up doing was just accepting the number that the assessor put in that we had been reviewing earlier, and the number we had from earlier. So I did mention we might have to adjust that number because it's without the VLT. So you're right, but it didn't matter to that our evaluation.
Well, it just creates the appearance that your stabilized revenue is higher than actual 18 and 17 when it's not.
Yeah,
So,
I understand. The only thing we should be looking at is just to ensure that the 3% FF&E and the 4% management were neither understated nor overstated. That'd be my only concern here. And because they should be going off, we're agreeing that they should be going off with the same issues.
So another question I have is the warehouse rent at 137,100. It says 550 minus parameters. Can you tell me or run through how you got that number?
At this point, I thought we were had some agreement, and we weren't planning on disputing that. I know that your number is even lower than that. So we had used a rent of 550, and then we had used your parameters of 4% when we had put in 5% for non-recoverables and calculated a shortfall. So the calculation is not in here. So our NOI is $27,000 higher because we're using a higher rent.
Oh, so that represents the net income?
Yes, yes. And we put it above. Now, all I'm concerned about here is that we don't want to use the wrong numbers on the 4% and the 3% because they are just to go on rooms, food, beverage, correct? They do 4 of these a year.
So you have applied 4% management and 10% or 15% FF&E to the warehouse.
And I mentioned that too, that we did leave that in because it was going to be a part of the same issue. But I'll answer that question in one sec. I just want to make sure we're on the same page here because the FF&E of 3% is only on rooms, food, beverage, correct? That's what we do?
Yeah, I don't see a problem with the FF&E
Yes.
reserve.
My income's lower, so my FF&E should be lower.
My question is on the management fee. You've applied it to all of your
Correct.
revenue, including the warehouse, which would already be net of that management.
That's correct, and you're correct there. That I said that earlier. That's something we should adjust as well. And it's $3,075,000. Let's see, 3. Doesn't make sense here. We can adjust that number very simply. I mean, we can. It's not 125, but it should be 125,000 or lower.
Yes, our overall NOI is 740,516. Correcting that. And that's changing my value to 6,170,967.
6 million what?
And then now, that's without the deduction of the FF&E. What I'm doing is I'm looking at the management fee line at 161,302 and just changing it to 125,825. That's changed the NOI to 740,510 after capping at 6,170,967. Now I am FF&E on the entire thing, and part of the reason is that, you know, there is a water slide part of it. It's all part of the same titled operation. Whether it's right or whether it's wrong, I'm of the opinion that the purchaser considered it because I spoke to him and he did. So my revised number is 553,870. 5,553,870. 5,553,000 rounded to 5,554,000.
What's your NOI?
My NOI changed to 740,510.
704?
Yeah, 740,510.
Can you say that again?
740,510.
Thank you, okay. Thank you. And that includes the strip mall?
That's correct.
Okay.
Mr. Chairman, may I continue with questions?
Yes.
So your proposal at 5,553,000 is essentially the same value as 2018, Mr. Newfield?
Yes, I don't have the 18 in front of me. I believe it's about 5.7 million approximately.
I believe it was 5.5.
Okay, 5.5.
At any rate, we see the net income has doubled over from 16 to 17 and increased again in 18, and yet your opinion is the value is flat?
I wasn't involved with this property 2 years ago, so I don't know who made what decision. So I can't speak to last year's number. I can only speak to this year's number.
No further questions.
Okay, Marcel, any questions?
Ready to go? None out of the way. What's the warehouse? What are they using that for? Warehouse?
Yeah, it's a kind of a industrial strip, just small users in there.
Just not really used by the hotel.
No, not at all.
Okay.
It's right on, what's the street, Midland, so
Yeah.
it's, all the good users who like to be near the methane hill.
Good. I'm done.
Free natural gas.
Good. The natural gas.
Questions, Rick?
Yes, you're saying the increase in room and food is completely due to flooding of native land.
It was a one-time issue, and
For both years, 2006?
well, yeah, but it was
Forest fires.
I packed up this morning, I had the news release, and it showed the dates that it was in effect. So I didn't make it, I have the dates somewhere. Oh, sorry, they're lying on my desk. But yes, it was a First Nations temporary housing.
All right, so,
Okay, the flooding occurred in 2011. Were they just transferring people to this hotel from other hotels?
No, there was 17 and 18 flooding. In a different, I guess they're happening everywhere. We found it this. I wonder if anyone's watching. My staff will just email me that information. But yeah, it's known fact. They're gone now. The springtime's coming. Hope springs eternal. No, I'm kidding. Nobody wants flooding.
No, of course not. That was my job to make sure that it was mitigated as much as possible.
Well, see, and you left, and now it's flooded.
Yeah, well, you're saying the flooding happened before I left. Okay, I got no more questions then. So thank you for that. Our last property on...
Mr. Chairman, may I just summarize quickly?
Sure.
So this hotel property has improved its performance dramatically from 16 through 18, over $1 million for each year. We can speculate that the revenue won't continue, but we don't know that it won't continue. If it does indeed decline, we will catch that in the next cycle when we get those financials. But it looks like that revenue may indeed continue. We don't know that they don't have contracts with First Nations that will mean a continuation of that revenue. So given that the income has doubled over 16, an increase is warranted. Taking a look at the strip mall at the back, we're valuing that the same way we do any other strip mall, as though it was on its own roll. In fact, it was managed by a different company than the one running the hotel. You'll see in the financial statements there's a numbered company that was running the strip mall. So we think a better valuation of it is to do it in the same way as any other industrial strip. The hotel valuation speaks for itself. We've reflected 100% of the actual performance of this hotel. We think it's fair and equitable. The reduction was in the strip mall, which I think perhaps was a little bit high. So I've made my adjustments there. But I certainly feel, given the revenues and expenses here, $7,989,000 is a fair value, and I ask the board strongly consider that value.
Okay, so maybe missing from...
Well, first of all, they are the same company. There are two statements because they choose to split it up that way. The former owner wanted it that way, and the purchaser bought the title to the whole site. That's not a pertinent comment to make. It is one operation.
If we look at the financials, you'll see a different company. different company.
Yeah, they're all Edward.
Well, the other one is a numbered company.
Yeah, they're both Edward.
Well, it's not reported that way.
You know why?
Well, let's
it's
not-
not reported that way. I sent you those financials.
Let's
That's not
not
what's
get, I
reported.
mean, let's just do your
No,
summary.
I know, that's what I'm saying, this isn't relevant or pertinent. Okay, think about income that's uneven, and how do you approach that in the real estate world? Do you assume it's going to stay? And in some cases, what the assessor's saying, when you're riding the market, that's the case. Right now, the office market is in decline, so you're going to see a decline in office values that may be recovered later. And what he's saying there is the case. There's a 2-year lag to get tax relief. That's the way our system works. Hotels are a different animal. Hotels are called externalities, not market-related externality, which means that's an external thing that caused it. The biggest bump we ever had in Winnipeg on hotels was in 1999, Pan Am Games. Now, if you were around practicing at the time, you know that when people came to the Board of Revision, the assessors tried to see, oh, look, I bet you're in 1999. The boards refused to hear that argument. They said, yes, everybody knows it's a one-off year. We're not going to base everything on 1999. They did exactly what I did. They averaged it out. And that's what you're supposed to do. This is the hospitality. These are hotels. They're not, it's not something that we had a good year and it's just going to get better like that. So we did the right thing. And that's our major area of difference. The other, of course, is the title issue, which is for me, it's so cut and dried. It's black and white. You don't sell half a property at one value and the other half at another. All of my information was gleaned through dealing with the purchaser and his motivations.
Again,
We're not talking about the sale. We're talking about the purchaser and his motivations.
Well, if you're talking about a purchaser, then you're talking about a sale.
Yes, but he reviewed the material when he bought it that we're looking at today.
That's fine.
And therefore,
I don't want to hear about a sale.
he tested. You're not hearing about it. You know, I didn't.
You're talking about the motivation of a buyer in a post-reference sale.
Post-reference material can be looked at in terms of trends, not in terms of applying a value. And please remember how respectful I was. I have not tried to slip it in. I didn't accidentally put it in there and say, oh, sorry about that, I'll pull it out, as we often see the assessment department do. What I'm telling you is that the depth of investigation we did was not just me trying to find a hypothetical value as of 2018, but an actual purchaser who did the same thing and made a decision based looking at the same information. He knew about the First Nations income as a result of it. He knew he wasn't going to rely on that. So in this respect, and my last comment is, even though it doesn't seem like it today, because we're certainly spending a lot of time, but maybe that's just hotels, there was a good, valuable exchange of information and on this property, and it may not seem like it, but the system worked fine. We did talk to each other. We did narrow down our issues. In a hotel, you can have this many issues, or you can have 2, or like the last one, just the one. And the last comment is, please remember, for both these properties we spoke of, the management fee, and take a look at what they've been doing from property to property. Thank you.
Okay, thank you. That concludes this property. Now, the next one on the agenda is 787 Mission, and I understand you're requesting a...
If it's possible, yeah.
There is a preliminary matter to be dealt with on this one.
Mr. Mercury just sent me his availabilities, or sent me to Visa on this matter, so he is already on it.
Okay, then we'll defer this one till a subsequent panel. We'll not even open a hearing on this one because it doesn't have to be this panel.
Mr. Chairman, I just wanted to note that this property was moved from a December docket for the very purpose of having legal representation here today. So the fact that it was rescheduled once already and legal representation isn't here, although it was rescheduled for that purpose, we would object to that.
I guess that we should confer as a panel for a minute here then. Let's just step out. All right. Given that this was deferred once already, and given that we're getting down to the end of the period, I think we should proceed today and get it done with. So we will commence on 727 Mission Street.
Thank you, Mr. Chairman. File number is 19-4761. The roll number is 0605081000, 727 Mission Street, and the owner is Jose M. Cabral. The value in the roll for 2020 is $1,740,000. Buildings on this site were built between 1975 and
Okay, we have to deal with the non-co-op first, so
of course.
deal with non-co-op.
So the non-cooperation argument, there are no expenses given on the mailer that was sent in to us, so it's incomplete information. If you'll turn to that page. Page 13 in my brief. You'll see no tenants listed, but no expense information is given. They have in the past provided us with income statements, I&Es with the expenses given, so they do have the ability to give us those numbers if they choose to. In this case, they chose not to, and that is the basis for our request. Not complying with our request for income and expense information, and therefore we're asking for the penalty for non-cooperation under section 53(3)(b) of the MAA, and if a reduction in assessment is ordered, that it follow 54(3)(2) of the MAA.
Okay. Questions of the assessor?
Yes, have you inspected the site?
No.
Does the assessment department send out mailers for vacant land?
Not as far as I know.
Do you have reason to believe that there's any income being generated from this property, or that it's owner occupied?
There is a business operating here, CJ Rentals, and they have submitted information to us in the past.
In the past?
Well, 2016 they did,
Right.
2017 they did.
What did they submit in that year?
Expenses.
Expenses, and who was that signed by?
The president,
What's his name?
Joe Cabral.
And who was this one signed by?
The manager,
What was the name on that?
Christopher Cabral.
Okay, Christopher Cabral. Those are my questions.
Okay. Marcel, any questions?
I might go to rate system.
I have
Right,
I have no questions.
Assurance rates.
Was there any follow-up on this?
I'm not sure. I believe this was already an extension mailer. You see the due date is June 29th. That would have been an extension. So I don't know if there was or wasn't.
May 13th, 30. They sent in May 31st?
Yeah, I believe that date should be 2017. 5/31/17.
Why should it say due date 2018?
Well, that would have been our 17 request.
I got no further questions.
Okay. Looking at the photos of the property, there's a few small buildings with Quonset hut on one side and a couple other smaller buildings, it looks like. And you say they've given expenses in past years?
Yeah, I can hand that out if you wish. 16 mailer, which shows the expenses.
Okay, well, that's fine.
I'd like to see it.
Okay, hand them out. Okay, I have no other questions. Does any questions arise from this material, Mr. Linton? No. Okay, then you can give us your presentation on non-co-op.
Thank you. My involvement started with this property when we did an appraisal for the estate after Mr. Cabral passed away. And so we did go and inspect it, and actually advised him that he should, the family, that they should appeal this because the building that's on there is decrepit, provides absolutely no contribution to value. It's a shelter for parking tractors under, so it's not a building, so to speak. And we did appraise it for CRA, and we said that to CRA. Mr. Cabral passed away in February of 2019 after an illness. And you'll note that the mailer is signed by his son, Christopher. So I imagine Christopher did not fill out the forms the same way as his father did. But he did it to the best of his abilities and his knowledge. He's got no income. He's got no expenses. It's a parking lot for equipment. And under the City of Winnipeg's mailer program, vacant land is never, they never send out mailers to vacant land. And anything that could be provided to them would be so totally misleading to the system as to be useless. But that's not the point. It's deemed vacant land. By an independent expert. Actually, it wasn't my appraisal, my daughter did it, but and by CRA, and in all intents and purposes, that's what it is. So they've done their best to comply. And the last time I handed out an obituary, the assessor at the time thought that was disrespectful. I do not think it's disrespectful. I think it's very respectful.
Well, we'll take your verbal evidence that the person has died.
And the estate was handling, he was ill. He at the point when the mailer's due, he was ill. He had not passed away, but the estate had to handle his affairs.
Okay, any questions of Mr.
So Christopher Cabral, he's the manager of the company that operates there?
No, he's Jose's son. His mother runs it now.
So he signed it as manager, he's not a manager?
I don't know. I guess he gave
That's
himself,
what he
I guess he gave himself a title.
So I assume that he's been involved in the business for many, many years, and he would know the ins and outs of the operation. He is the manager, and
No, that's not a safe assumption.
no. But it is safe to say that they didn't fill out the expense information.
There are no expenses listed on there, nor income.
That's all my questions.
Okay, that's all questions of Mr. Newcomb.
Nope, good.
All right.
Any questions?
Okay, I have no questions, so we'll now consider the non-co-op, and so if you can give us the reading. All right, we'll come back into session. We discussed this, and given the circumstances of the death of the owner, who seemed to be the general manager, we will deny the non-co-op in this situation. Although we'll speak generally, when there's blank mailers returned, that's not what we're looking for. So just in this special circumstance, we will deny. So you can proceed.
Thank you, Mr. Chairman. So the buildings on site were built between 1975 and 2012. Wall heights vary from 9 to 27 square feet, pardon me. The zoning is M3 manufacturing heavy. The land area is 214,898 square feet. The buildings on site have a leasable area of 7,708 square feet. The land plan ratio is 33.02. Turning to page 2, there are no subject leases found. This is an owner-occupied premise. The occupant is CJ Rental and Contracting Limited, and they use the entire property. We have some rent comparisons showing on page 3, ranging between $6.95 and $8 a square foot net to support the value, the rent that we used in the valuation. On page 4 are some comparisons of land sales. There's a lot of land in comparison to the buildings here, so we're applying an amount for excess land. And the comparisons show a range between $403 a square foot and $1214 a square foot. The additional land area that we're assessing for is 129,538 at a rate of $7.09 a square foot. We believe that some of these comparisons are a bit older and would be a little bit higher, closer to the reference date, but we believe $7.09 is a fair value for the land. Turning to page 5, we have our income workup. As stated, the leasable area is 7,708 square feet, and we've used a model rent of $7.46. The potential rent is $57,502. To that, we applied a vacancy loss of 5%, expenses of 2%, and used an overall cap rate of 6.65%. Again, the value from the income approaches $783,000. To that, we add the land value, which I noted at 129,538 square feet at 709 to drive 919. Additional building value would cover some of those oak buildings, the storage shed and garage, I believe. Nominal value of $38,000. The total is $1,740,000, which is the value in the roll 2020. Cap rate table is shown on page 7. Page 8 are the MAA excerpts. Turning to page 9 now, we have an overhead view of the property. As you can see, it's a long and narrow property, and it's obviously not vacant. There are many trucks and equipment and garages and buildings on it. Definitely not a vacant lot. Turning to page 10, we have some different views there. You can see from those views that there's equipment there that would be part of the equipment rental business. It looks like there's a plant to make cement as well. Turning to page 11, some other views of the property and some street views of the property are shown on page 12. In those street views, you can see there's cement trucks there, part of the business. Again, this is not a vacant lot. There is a viable business, a business that's been here since 1990. Page 13, 14, 15, the mailers as we've already gone over. And our addenda information is at the back here. Most of you have heard this, if not all of you, so I won't go over that again. Again, this is a property in an industrial area that supports a viable business, a rental business, and you can see they're making good use of the land. But in comparison to the buildings on site, there is excess land, which we've put a value on, in addition to the income generated from the buildings. So our value is a sum of the total, and we believe the value at $1,740,000 is fair for 2020, and we ask that the board confirm.
Okay, questions, Mr. Newfoundland?
Yes, on page 5, evaluation, was this all generated from the model?
Yes.
And so I may have missed it, but how much additional land are you attributing?
129,538.
129. So what does that leave as a remainder in terms of ratio?
I'll subtract that from 214, 898, and the remainder is
85, about 11 to 1?
I'll take your word for it.
Okay. And then, like in preparing this, are there places on here where it's been overridden, like this additional building value, or is this something that's already in the system?
Yeah, I believe that's in the system of the depreciated costs of the old buildings, storage shed, and I believe there's a double garage in there.
Okay. And so the model generates this value, and then your comparables for rent on page 3 and sales on page 4, I take it that those are yours?
Yes.
Okay. And you did say you haven't inspected the site?
No, I haven't.
So no one's been out to check the quality on this building?
I believe a colleague of mine has been out fairly recently. 2013, I believe.
2013.
Yeah.
And, sorry, I just, was your map. Do you have a location map here? I thought I missed it when I was glancing through.
Page 9.
Right. Okay, so it's on Mission, north side of Mission, and between Archibald and I guess what's on the other side that hooks up, eventually Mission hooks up with Plessy? Not Plessy, I'm lost. St. Boniface, I'm lost. Okay.
Right at the end of the Blanche, isn't it?
Yeah, okay, right. And the land behind it, where the thatch goes through, this is a former rail right away?
Yeah, I'm not sure.
Okay. And Mission Street at this juncture, is this paved,
I believe so.
curbed?
I don't know. Let's see if we can see it in the street views.
I'm looking at page 12, it's not.
Doesn't look like there's curbs.
Yeah, okay. And the site itself is not paved?
As far as I can tell, no.
Your comparables for rent, page 3, do any of them share similar locational issues?
No, I don't believe there's any issues with comps.
Dugald, Durand, Terracon, Elan, they're all in the general St. Boniface industrial area,
Yeah, they're all good.
all
Well
serviced by
located.
4-lane grade, commercial grade streets.
Probably.
And 1500 Regent, that's, would you agree that these are better locations?
Yeah.
Okay. Same question in curiosity on page 4. You've got 3 from Marion Street and 1 from Mission, and of course your Mission value is a fair bit lower than the Marion's, is it not?
Yeah.
So wouldn't that perhaps suggest that more emphasis should have been placed on the Mission value per acre?
Could be. They're good comparisons because they're close in size to the subject property, and they're all zoned M3 manufacturing heavy.
Right.
So yeah, I acknowledge they're a little bit less, but they're a little bit older as well.
Well, your newest sale is the lowest sale, is it not?
Yes, it is.
Okay. And your newest, and that particular sale is also on the same street as the subject. Okay. I didn't have, you don't have that number per acre applied. 2.97 acres is, so you're in at 309,000 per acre, correct?
Well, I looked at the square foot rate, so I'll take your word.
Yeah, well, I was just converting it to, what was your per square foot rate? 8 something?
We're using 709.
709, okay, yeah, okay. So, yeah, that's roughly a little over 300,000 per acre. So, out of curiosity here, at what point would the assessment department consider that, because there's so much land here and the building is insignificant in size, that perhaps the valuation goes the other way, in that you value it as land and then you add in the value of a building?
At what point?
Yeah.
Well, I mean, they're still adding on. They added on as recently as 2012. So I think there's some value to the buildings. So seeing as they're adding on to the buildings as recently as 2012, we're still comfortable with an income approach and then adding for excess land.
Those are my questions, thank you.
Okay, any Marcel questions?
What size was the building they added on in 12?
Do you have that?
I didn't see the permits in there.
It was 2,240 square feet, and I do have a handy map to show you. It's this one here, right here.
Yeah.
A double
Garage.
two-door garage.
All right, let's take a look at that.
That's the addition.
Right.
2012.
It didn't give the particulars on it, did it? On the garage?
Other than it's 2,240 square feet.
Yeah.
Is that what
But
you want?
Did they put a concrete pad inside, or did they leave this one gravel like this?
I'm not sure. I haven't been in it. I'm not sure. There might be some pictures in Mr. Newfield's. Looks like a concrete floor.
We have to fit in?
Page 4 of Mr. Newfield's brief.
Oh, Mr. Doctor. Okay, I haven't
Yeah.
looked at it yet.
Okay.
Okay, we'll go over this. You, Mr. Chair?
Okay, could I ask you if you had, no, Brady, if you had questions?
No questions.
So the extra building value that you put there, $38,000, is that Quonset hut?
No, I don't think it's that. Had it listed as a storage shed and a double garage. So if we can locate that somewhere in the overhead.
Had the word all down like that one.
Yeah, at the bottom of page 10, to the left of the main buildings, there's several structures there. I believe that represents those additional.
In the corner of the lot, Joey?
Well, page 11 has a better view.
That's where the font is.
Yeah, not quite that far. Well, there's a building there, that might be one of them, and there's some sheds there to the left of that.
The trailer. And a shed.
Right. I mean, it's a nominal value, but that's what it represents.
All right, those are my questions, so you can proceed.
Follow-up question. On the picture you showed, do you see any heating vent chimney sticking out of the addition?
Out of this edition? No.
And so, is your understanding it's heated or unheated?
I'd have to refer to the notes, which I don't have here, so.
And where in the building is this upper level?
It looks like that garage on the far right of it, it looks like there's some office space. That looks like 2 levels there.
The windows there?
Yeah.
Okay, thank you.
Okay, you can proceed with your presentation.
Thank you. So we inspected and appraised the site in May of last year for the estate. So our comments do come from an on-site inspection, and we concluded that this isn't post-reference, but that there was marginal to no value in building improvements. The 3,500 square foot.
Mr. Chairman, if I may, the appraisal is dated as of May the 14th, 2019, the value date, which would be post-reference.
Okay.
Looking at page 3,
It's
of
not,
Mr. Neufield's brief.
it's got nothing to do, oh yeah, there you go. It's got nothing to do with value. You can disregard the value there, please. It has to do with, as we all know, market is based on the reference date,
Yeah,
but
it's
physical
Physical
condition.
condition, you can talk about physical conditions.
That's what I was talking about.
Okay.
So we inspected it, and the physical condition is negligible. The 3,500 square foot original building, you can see in the pictures, does have space heaters in it. And you can, the pictures on page 4 show the top left corner shows you those 2 space heaters. The addition does not. The quality and condition of this is poor. Requiring far too much deferred maintenance. It couldn't be used for rental because it doesn't meet code. It is just a shack for storing their equipment in. And you'll note on page 4 what they store inside there. That's not valuable merchandise. There's not color TVs in there. There's a stretch limo, an ambulance, and some tractors and forklifts. So this is a compound. M3 zoning, the most important feature about M3 is the permissibility of uses, and outside storage compound is one of those uses, but it is a junkyard. Well, so our valuation confirmed that there is no value, and I think the reason that page was put in was just to show. And I think you'll note I asked the assessor a question before, at what point do you just focus on the land and perhaps add an extra value for building improvements instead of trying to value the building improvement and adding excess land. The time is well past for this. No one is buying this for the building. It's an immediate bulldoze. It's for the land and the zoning. Now, by the way, the other part, there are the other parcel here that is listed as Lot A and C, that's across the back way, that's also theirs, which we appraised for the estate at the time.
Now, on page 1, these are the actual sales that we relied on for doing our valuation, and you'll note that the date on all of them is within our reference period. And we had a number of sales, and I believe we have the same mission sale that the assessor has. Perhaps not. M3, 2.9 acres. Yes, okay, well, they had 2.94, so there's a little bit of, maybe it was 2.94, our value would drop to 175 an acre. And we were looking at properties not on Dugald, not on Marion. We were looking for off-street lots. And virtually all of ours are M3. There are a few M2s in there, but then they're in the St. Boniface Industrial Park. So the M3 sales within the reference period, high end of 276,000, low end 164,000 per acre, and we valued it at 165,000. More to do with the permissible uses on it, and but it is a poor location for many uses. This is the last real enclave of M3 zoning within Winnipeg, as the rest is being gentrified out of existence, and so this hasn't been touched. And it's M3 is going the way of recycling yards, and because that's the few uses you can get out of it now, junkyards that are growing in popularity. So it's about the only demand these days is for wrecking yard junkyards. The building, as we say, now, because that is post-reference putting a value on it, so it's not there for any reliance. It was a contributory value for buildings that we told CRA on a post-reference amount. I have the actual appraisal here, but in our analysis, we just said that the ultimate reconciliation is that they were beyond a state of economic repair, and that the purchaser in the marketplace wouldn't put any emphasis at all on these buildings. It would just strictly be the land. So you can't hypothetically assume something has value. So I think fairly simply that's our value, it's the land. And using actual sales from M3 zone lands and industrial and with similar location qualities.
That's your presentation?
Yeah, short.
Okay. Mr. Penn, any questions?
Yeah, just a couple. So you say the property was appraised for CRA, so for estate tax planning?
Not planning. Let me just see if we have a sub in here. For reliance by CRA.
Okay, thank you. And you stated that the buildings in use, the main building in use is not up to code?
Oh, not for human occupancy. There is no real code on garages and sheds.
No, I mean the main building.
Yeah, it's not fit for human occupancy.
So they're not using it?
It's not part of their operation. They don't. It's a garage.
Right. So there's no offices in there?
Let me see if we have a picture of an office in there. There could be a desk in there. Doesn't mean it's worth anything.
No, I guess I'm just concerned if it's not fit for occupancy, there shouldn't be anything in there. Should be vacant.
Well, it's an owner's own building, so what I'm saying is it's not going on the marketplace. and being rented out.
Right.
It's the cost of getting it to that standard to rent it out is.
Well, my question is, it doesn't meet code. I'll leave it at that.
No, I'm not going to say it that way. It's just not up to any standard. It's a tear down.
Right, that's all the questions.
Okay, next on the questions?
Yeah, what was the value of the city put on the land?
The land?
Yeah, $7
$709
per square foot.
Yeah, 919,000.
So 309,000 an acre. You had mentioned that it should be done with land value and then add something to the buildings, but you didn't add anything to the buildings.
Well, because the gas for the bulldozer costs money too.
Well, it was your words that said we should add
Yes.
something.
Well, no. My words were that at some point, properties reach the stage where it's the main interest is the land, and then look, is there a contributory value from the buildings that you could add on? And if there is one, what would it be here? $20,000. You can see that, again, post-reference, my daughter thought, well, maybe another $65,000 on a post-reference basis for that. $10 a foot. I'm of the belief that on a 3-acre site like this, 5-acre site like this with a building like that, it's an impediment to sale. I think if someone came along and wanted to buy it, they'd say, I will buy it, you deliver it to me without a building on it, which is typically the way the marketplace would react.
Has this site got sewer and water?
I believe that it does.
Yeah, I don't know.
Well, certainly they reported those as expenses in
Okay.
2016.
Yeah, it's reported as expenses, but is that septic or city?
Reported as hydro and water and sewer.
Right.
The sewer,
So it is sewer.
I've got no further questions.
Hey, Ray, any questions?
No questions.
Okay, thank you. I have no questions then. So then that concludes this morning's hearing. So thank you very much for your presentation.